Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
The economy is robust. This is usually said by people who have never had to decide between buying cheese or paying the electric bill. My door is always open. That isn't an invitation, it's a warning that I can hear you complaining from the hallway. Our target demographic is anyone with a wallet and a pulse. Preferably in that order. If at first you don't succeed, call it version 1.0. Circle back, a polite way of saying, let's ignore this until we both die.
This year's equity fundraising tells a two-track story. Roughly half the supply has come via OFS, promoters, PE funds and strategic holders cashing out, while the rest is fresh capital for growth through IPOs, QIPs and rights issues. Translation: markets are funding expansion and providing exits at the same time. That's healthy, but it also caps upside in the short run. Supply matters. When selling dominates issuance, rallies need stronger demand and not just better narrators. RBI trimming US Treasuries below $200 billion is not a tantrum, it's portfolio management. Less duration risk, more gold, and a quieter nod to geopolitics. And the real punchline? Gold's rally means RBI's balance sheet just got shinier, setting up a hefty surplus transfer to the government. Markets fret flows. Central banks count carry, valuation and optionality. This year, bullion did the heavy lifting. India's market leaderboard says a lot without saying much. Reliance sits on the top, conglomerate scale plus optionality. Banks still dominate because credit is the economy's plumbing. Tech holds its ground but no longer towers alone. So this isn't about what's exciting, it's about what compounds reliably. Capital flows to balance sheets that can absorb shocks, fund growth and stay boringly profitable. In markets, size is not everything, but it's rarely an accident. FY26's first advance estimates underline a familiar pattern. Investment is doing the heavy lifting. Gross fixed capital formation is back at 30% of GDP, powered by public Capex and infra momentum. Real investment growth near 8% keeps the supply side humming. Consumption meanwhile is steady but unspectacular. Private spending growth has eased to 7% despite low inflation and services-led demand. In short, India is building ahead of buying. Great for medium-term capacity, but near-term earnings still hinge on when households step up. India's rural engine did the heavy lifting in 2025. Passenger vehicle sales up 12% in rural versus 8% in urban, pushing all India growth close to 10%. Two takeaways traders shouldn't miss. One, affordability plus availability, better roads, financing reach are finally compounding outside metros. And two, fuel mix shift is real. About a third of sales are CNGs, hybrids, EVs, cushioning wallet pain and boosting acceptance. Urban demand is not weak, it's mature. Rural is catching up. If this persists, expect OEM mix upgrades, stronger ancillaries, and steadier volume visibility into FY26. India's earning growth premium versus emerging markets has slipped below its long-term average, even turning negative recently. Odd, even India still leads EM on real GDP growth. The gap is in growth, its earnings translation and margins, where emerging market peers have surprised on the upside. The swing factor now is the rupee. A stabilizing currency does three things fast: improves EPS in dollar terms, reduces foreign investor return drag, and lowers input volatility, helping margins recover. If earnings momentum improves even modestly while the rupee stops sliding, India's relative equity performance can mean revert versus emerging markets without needing heroic GDP assumptions. 2025 has been a record year for FPI equity exits. Over 1.66 lakh crores out, even as debt absorbed 61,000 crores. This isn't a vote against India's growth story, it's a pricing and currency call. Equities faced valuation fatigue and rupee uncertainty, while debt offered carry plus index inclusion optics. Net foreign capital did not leave India, it changed lanes. Until earnings visibility improves and the rupee steadies, FPIs will likely keep preferring yield over risk, bonds over stocks. When that flips, equity flows can return fast, but they will want proof and not promise.